What do you call it when the world's largest economy borrows $4 million every minute, while its biggest creditor pulls away? In 2025, the U.S. entered the second quarter expecting a healthy $850 billion cash reserve, only to find half that amount. At the same moment, China unloaded $1.7 trillion in U.S. Treasuries, slamming the dollar and forcing Washington to borrow $514 billion just to stay afloat. Mortgage rates soared, inflation spiked, and U.S. debt stopped being considered safe. This wasn't just a market glitch, it was a global signal, and the fallout could redefine economic power worldwide. The U.S. debt crisis, a $4 million problem every minute. At its current pace, the U.S. accumulates over $4 million in debt every 60 seconds. However, things took a dramatic turn when China began selling off its treasury holdings. Beijing liquidated $1.7 trillion in U.S. bonds, creating an immediate borrowing crisis that forced the Treasury to raise $514 billion, an alarming 317% surge from February's projections. According to Bloomberg, this move was sparked after the U.S. blocked Chinese EV battery giant CL's IPO, a policy shift that weaponized finance. The result? A massive plunge in the dollar, rising bond yields, and soaring gold prices as global investors scrambled to move away from dollar-based assets. The U.S. is now left to finance geopolitical actions with borrowed money, leading the world to question whether Washington can sustain its aggressive stance. The catalyst, a trade war, and China's response. The triggering event was Washington's attempt to block U.S. banks like J.P. Morgan and Bank of America from supporting a $5.3 billion IPO of CL, China's dominant EV battery maker. While the potential lost underwriting fee of 0.2% might seem insignificant, the deeper implications were far-reaching. The move severed the U.S. financial sector's access to China's massive market, threatening billions in potential future deals. China's response was swift and calculated. They sold off a significant portion of U.S. debt and made moves to strengthen their financial independence, shifting away from reliance on U.S. Treasury bonds. Beijing also aggressively increased its gold reserves to 2,292 tons, marking a 5-month streak of increases. This wasn't just a market reaction. It was a structural pivot away from U.S. financial dominance. The debt crisis deepens, $514 billion borrowed to survive. As the second quarter of 2025 began, the U.S. government expected to start with $850 billion in cash reserves, but faced a $46 billion shortfall, less than half of what it had planned for. This shortfall was worsened by the return of the federal debt ceiling in January, which forced the government to borrow far more than expected. According to Treasury statements, had the cash reserves not collapsed, borrowing for the second quarter would have been $53 billion lower. Yet the real question is why U.S. officials held on to outdated assumptions about the state of liquidity. Bloomberg reported that Wall Street was bracing for a borrowing figure closer to $255 billion, not double that amount. This discrepancy raises deep concerns about how fiscal policies are being planned, tariffs and inflation, the hidden cost. Some analysts speculated that President Trump's tariff hikes might help boost Treasury receipts and plug the growing budget deficit. However, early signs show the opposite. Apple reported a projected $900 million loss due to tariffs in the second quarter of 2025. The impact? Prices for the upcoming iPhone could rise, and consumer inflation spiked to 3.4%, up from 2.2% in the previous quarter. This wasn't just a short-term economic adjustment, it's a structural squeeze. With import costs climbing and corporate margins shrinking, tax revenues may fail to keep up with rising interest rates on U.S. debt. The tariffs meant to stabilize the balance sheet might, in fact, be tightening a fiscal noose. Mortgage and loan rates soar, the consumer fallout. Behind every Treasury auction is an American family paying more for less. With China's exit from U.S. debt markets, yields on 10-year bonds soared past 4.6%, and in May 2025, mortgage rates hit a 15-year high of 7.8%. Auto loans surged to 9.1%, and student loan rates hit 6.6%, creating a severe erosion in affordability across the board. The Consumer Price Index, CPI, rose 3.4% in the first quarter of 2025, driven by increasing costs in food and energy. That's not just economic friction, it's real-world pain for households. Bloomberg reported that household purchasing power dropped by 5.1% year-over-year, hitting middle-income families the hardest as imported goods, now priced against a weakened dollar, climbed rapidly. Global capital flight, allies hedge their bets. As the U.S. entered a period of economic turbulence, its allies began to hedge their bets. In the first quarter of 2025, foreign investors offloaded a staggering $317 billion in U.S. assets, marking the steepest capital flight since 2016. Notably, Saudi Arabia, a former top 10 holder of U.S. Treasuries, trimmed its holdings by 22%, reducing its stake to $126.4 billion. Meanwhile, a bipartisan push in the U.S. Congress forced major asset managers like BlackRock and Vanguard to divest $812 billion from Chinese companies. This move further politicized global capital flows and caused Asian IPOs on U.S. exchanges to plummet. The U.S. isn't just losing investor confidence, it's slowly forfeiting its monopoly on global financial trust. China's parallel economy, a threat to the dollar. While Washington struggles to maintain its financial dominance, Beijing is building alternatives. In 2026, China plans to debut a national credit rating system to bypass Western rating agencies like Moody's, S&P, and Fitch, which have cost Chinese state-owned enterprises up to 120 basis points in excess borrowing costs. At the same time, China is upgrading its domestic cross-border payment systems to reduce reliance on SWIFT, the dollar-dominated network vulnerable to U.S. sanctions. Parallel to this, the BRICS nations processed $56.4 billion in transactions in the first quarter of 2025 alone, with nearly half of those transactions conducted in local currencies. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way.